All right, let's dive right into this explainer. Today, we're uncovering exactly how Wall Street makes sure its biggest risk takers actually have skin in the game. We're going to look directly at the sustainability accounting standards for investment banks, really zeroing in on how employee incentives are tracked and disclosed to protect the entire financial ecosystem.
Because really, it all comes back to one massive question, right? How do we prevent another financial crisis? Regulators figured out pretty quickly that you can't just stare at a bank's balance sheet. You actually have to look at the people. You have to look at how the individuals managing all that money are personally incentivized. Think about it. When employee compensation heavily emphasizes short-term wins, it completely breeds dangerous behavior. If a trader gets a massive payout today for making a bet that blows up the firm 3 years from now, the whole institution and its long-term corporate value is totally at risk.
So here's our roadmap for today. We're going to follow the money like a detective story, starting with the problem of excessive risk, identifying the prime suspects, tracking their pay, examining clawbacks, looking at level 3 assets, and finally, seeing how all of this protects long-term value. Let's get to it.
Starting off with part 1, the problem with excessive risk and how it sets the stage for systemic threats. Moving right along to part 2, who exactly are these material risk takers? Let's identify the prime suspects of Wall Street.
So, if we want to fix this incentive problem, we first need to know who actually holds the power. The accounting standard calls these folks material risk takers, or MRTs. Basically, these are the employees whose everyday decisions have massive rippling effects on a bank's overall risk exposure. But how do you actually classify someone as an MRT? Well, the framework gives us some super clear criteria for spotting them. If you're on the supervisory board, if you lead a major business unit, or if you can just straight up approve or veto trading book decisions, boom, you're an MRT. But here's the really wild one. If you are simply in the top 10% of the entity's highest paid employees, you are automatically on the list. Okay, part 3, tracking variable remuneration. It's time to follow that incentivized money. Now that we know who our suspects are, we gotta look at their weapon of choice, which is how they get paid. You've got fixed remuneration, that's permanent, based on experience, and crucially, it does not incentivize taking crazy risks. But variable remuneration, that is performance-based. By its very nature, it is literally the fuel for risk assumption. To actually track this danger, SASB gives us metric FNIB55B.1. Banks have to calculate a very specific ratio. They take the aggregate variable pay of all those MRTs and divide it by their total pay. This spits out a clear percentage for investors. I mean, think about it. If an MRT's pay is, say, 90% variable, well, you immediately know they are highly incentivized to roll the dice. But, the standard goes even further than just giving us a percentage. The bank actually has to explain how these pay policies fit into their broader risk framework. Like, what is the board's role here? How is the chief risk officer involved in all this? Investors really need the inside scoop on exactly how the risks tied to this variable pay are being managed by the folks at the very top. Which brings us to part 4, clawbacks and malus provisions. Basically, the justice system for risky bets gone wrong. So what actually happens when the behavior fueled by all that variable pay goes horribly wrong? That is exactly where malus and clawback provisions come in. These are explicit, after-the-fact risk adjustment mechanisms. In plain English, it means the bank has the legal authority to reach right back into an employee's pocket and lower or totally cancel the cash and stock they were already awarded. And that brings us to our next metric, FNIB550B.2. This one calculates the actual percentage of MRT variable pay that had to be clawed back during the year. You just take the amount clawed back and divide it by the total variable pay before that adjustment. It kind of acts like a corporate lie detector. It shows investors if the bank is actually stepping up and penalizing bad risk-taking or just talking about it. And here's the kicker. When a clawback is actually triggered, the standard forces the bank to publicly explain themselves. They have to tell investors, hey, were our initial risk estimates just completely wrong? Did some brand new risks pop up late in the game? Or did a massive, unexpected loss just slip right through our fingers? It brings this amazing level of total transparency to failure. All right, part 5, pricing level 3 assets, auditing the unobservable inputs. Now, you might be wondering, where do traders usually find the wiggle room to artificially inflate their performance? Usually, it's level 3 assets. These are super complex financial instruments where the fair value relies on what accountants call significant unobservable inputs. Because they don't have clear publicly available market prices like a normal stock would, they are highly subjective, and that subjectivity makes them a prime target for intentional mispricing by traders who are just looking to boost that variable pay we talked about earlier. To counter this exact issue, metric FNIB 550b3 demands some strict disclosures around the bank's internal police force. Banks have to explicitly outline exactly how they supervise traders to prevent this intentional mispricing. They also have to detail the precise validation mechanisms they use to double-check those highly subjective assumptions. But there is a final, honestly brilliant layer of accountability here. Because it's not enough to just have supervisors. Banks actually have to reveal the incentive packages for the employees who are validating those tricky level 3 estimates. The watchdogs literally have their own pay scrutinized to make absolutely sure they aren't being secretly incentivized to just look the other way. And finally, Part 6, protecting long-term value. Bringing transparency to financial governance. When you step back and look at the whole picture, you really see a complete accountability ecosystem at work. By identifying the material risk takers, calculating the exact percentage of their variable pay, reporting transparently on clawbacks, and keeping a tight leash on level 3 asset pricing, well, investors finally get a clear, honest picture. They can actually ensure that the bank is prioritizing long-term corporate health over short-term reckless rewards. The reporting structures exist, the accounting standards are officially set, but until these metrics are fully and widely disclosed across the entire industry, do we really know if the right people actually have skin in the game? It's a massive question every single investor should be asking. Thanks for joining me on this explainer, and keep questioning the numbers.